Welcome back. AT&T stock is on a confusing run over the past 2 days. It announced that it's spinning off its media division, WarnerBros. And initially on the news, it got excited because it's merging with another media conglomerate, Discovery. But then it decided that that wasn't enough, and because there was still some sort of confusion on the deal, the stock actually closed lower on the day and now is down by 2.67%. And pre-market, it's down to $29.70. So, of course, I love a good deal. AT&T is also a dividend-paying stock, although they said that they would cut their dividend in order to decrease their payout ratio to pay off more than their $160 billion in debt. So the cash that they'll get from this deal, which is approximately $43 billion, will be used partly to pay down this massive debt load, but they will also be cutting their dividend. And I think as a result of that, plus as a result of the murky acquisition details, this stock is falling by, again, 5% pre-market. So we're going to go over the technical charts to see whether or not AT&T is a buy right now, as well as a little bit more into the minutia of the details. But again, it is a little bit confusing for me in terms of what exactly AT&T is and is not getting, and what the details are of the deal with Discovery. Okay, so one will look at this email that I get from the Morning Brew, and they talk about what's going on in business and media today. So again, it's just an email, and if you're interested to find out news on the stock market and financials in a pretty funny way, I'll link down below in the description so you can check that out if you'd like to. So this is not sponsored, by the way. So yesterday, AT&T confirmed reports that it's spinning off its entertainment division, Warner Media, and merging it with Discovery to create a 120 plus billion media company spanning news, sports, film, scripted and unscripted programming, and whatever 90 Day Fiance is. In other words, Anderson Cooper, Guy Fieri, Harry Potter, Randy Finoli, and Wonder Woman will all attend the same party next year. So AT&T shareholders will have a majority stake, 71%. So I think that's what a lot of the shareholders got excited about, and that's what pushed the stock up. And Discovery CEO David Zaslav, who secretly architected this deal for several months, will lead it. As for Warner Media CEO, and New York Times reported that Killar wasn't told about the deal until recently and has hired a legal team to negotiate his exit. So, ouch there. The new company will be better after the deal, but it will take time. So I think this is the news that sent the stock down afterwards. Confusion of how long it'll actually take to complete the deal and for this deal to be profitable for both companies. Both Warner Media and Discovery are still transitioning away from their dependence on cable, but he thinks that the new company can eventually sign up 400 million streaming customers. So this just shows you the competitive landscape of the likes of Disney Plus and Netflix. And I actually own some stock in Viacom CBS, which is another up and coming sort of wannabe streaming giant. So we'll see how that goes. And then I usually like Motley Fool articles. So again, what AT&T is doing is, again, spinning off its media division to create a fully new company, and this will allow AT&T to focus more on its main drivers of growth, which is their 5G networks, and well, telecom networks in general. So again, AT&T would receive 43 billion cash in debt, and its shareholders would receive 71% of the new entity. Discovery shareholders would own the remaining 29%. So because this media company will be a new company, a lot of AT&T shareholders are like, will I receive dividends from both companies? I don't think that will be the case. And I'm not even sure if the new network will pay out a dividend, but we'll have to see. Again, a lot of the terms of the deals are not very straightforward right now. So it's going to combine content from the likes of HBO, CNN, TNT, TBS, HDTV, and Food Network. It's forecast to generate 52 billion annual revenue and 14 billion in EBITDA by 2023. So it'll allow Warner Media and Discovery to accelerate their streaming initiatives centered on popular platforms HBO Max and Discovery Plus. And it's supposed to create 3 billion in annual cost savings. So it's still subject to regulatory and shareholder approval, but after it may be, again, it may be a very, very solid company. Okay, so now that the markets are officially open, let's take a look at the price. So yeah, it's down by almost 5.5%. As you can see right now, there's a pretty juicy dividend of $2.08, which after the cut from 60% payout ratio to 40% payout ratio, it'd be about $1.38 in terms of the dividend that you receive. So I think a lot of people own this stock because of their dividend, and then really not liking this decrease. Okay, so let's look at the charts here. So this candle right here represents the trading day. So right now we can see that it just crossed below the 50-day moving average. And here we're looking at the 6-month chart. Actually, let's do a year chart because I feel like it's a bit more accurate. And let's see where a significant resistance pattern is. Okay, so here we can see, of course, hitting that 29.52 level here. And we can see that there's significant support at around the $28, $27 range. So there's one level right here, kind of another level right here if you take it, and kind of right here. And so it tends to bounce off of that support. And so we're still nowhere near that level at $29.58. So you might want to wait until that level is reached. But we can see a significant decrease in the relative strength index at 34. So you may want to accumulate a couple of shares and then accumulate some more shares, cost average downwards if the stock keeps going lower. However, there is a significant, other than the $28 level, there is a significant level at around the $26 mark, as we can see right here. But other than that, I would say around $28 is a very good price to accumulate shares because that seems to act as a resistance and to bounce the stock back off afterwards once it hits that. So again, you could potentially wait until the stock goes to around $29, $28, and then accumulate shares. I don't know if it will go and do that, especially since in volatile times, stocks tend to do whatever they want to do. So yeah, make your own decisions. I think I may be buying a couple of shares of AT&T. I don't hold any AT&T yet, but I do think it's a good play on 5G, as well as its now new streaming prospects with Warner Bros. And Discovery. So let me know what you think about this video. Of course, I always just ask that you smash the thumbs up button. It helps my channel out in a tremendous way. And check out my links down below. So for example, to my free Discord group where we talk about stocks such as Baidu, which just announced their earnings and had very good earnings, and dips in the market and massive opportunities, as well as inflation hedging, et cetera, et cetera. And also subscribe if you haven't already for more content like this. And yeah, take care. Love you all. And I will see you in the next one.